Welcome to Finance with Justus, I am Justus. If you like dividend stocks, probably in the last weeks you have heard of Walgreens a lot. A lot of dividend investors are buying it because of its extremely high yield of 8.8%, which is usually only seen with like energy stocks and tobacco stocks. I used to own Walgreens and I think CVS is the better stock. And today I'm gonna tell you why it is just the better company in my opinion, and even at its higher valuation is much better than Walgreens. While both have a pharmacy business, CVS has developed in the last few years to be much more than just a simple pharmacy. While yes, Walgreens is also expanding into primary care and other specialty services, CVS went much further. They acquired multiple companies like Aetna, Oak Street Health, etc., to which we're gonna come later, and they're now an extended health business. They offer health insurance, they offer primary care, and that is where the future lies for these pharmacies. Top officials at CVS in interviews are saying that the retail pharmacy business is, while growing, in low single digits. So the future for CVS and Walgreens is probably not gonna be there. The fear with those companies is that Amazon or Mark Cuban will compete with them. And yes, those segments are easy to compete with. And you can see that with the growth rates. While they expect healthcare benefits, their insurance business, etc., to grow by 11 to 13%, their retail pharmacy business, they expect to grow by 1 to 3%. Of course, this is just for 1 year, but that's in general how the growth trends are. The retail pharmacy business is just not a fast growing. And this is where CVS is way better positioned than Walgreens. And you can see that in the outperformance. Late 2018 is when CVS bought Aetna, the health insurance company, and ever since then they had an amazing growth streak. They have acquired multiple companies throughout here, and all of them so far have worked very well to increase the top line revenue. Revenue growth is one thing, you can always buy revenue growth with acquisitions, but it has also translated in massive free cash flow growth. A pharmacy business which managed to go from $3.26 per share in 2013 to now $13.78. That is amazing. And you can see, even since 2017, they have been growing free cash flow a lot. Now if you compare this with Walgreens, yes, they have been growing since 2018 and before, but look at the free cash flow. They have been in a decline since 2016. They just haven't been catching up with CVS. And that is why they have such a low valuation right now. They're just not growing. They're declining. Their margins have been constantly dropping since 2016, and there is just no end in sight so far. So this is a pure dividend play in that case. And in that case, they would just be spending all their money on the dividend and not being able to grow at all. Now, what is it that Walgreens did with their massive amounts of free cash flow? Because remember, they had a lot of cash flow until 2022. What did they do with that? It's simple, they bought back a lot of shares, at least until recently. Which is sad, because they bought back stock around here when it was at like, let's say $60, but now when it's at $21, they're not buying back any shares. Why? They have no cash. They are basically out of liquidity. They only have $970 million right now, down from $4 billion. And at the same time, they have net debt of $35 billion. And remember, that $35 billion is on currently $800 million negative free cash flow. Even if it returns to like 2020 levels for cash flow, where they had $3.5 billion, that is over 10 years of free cash flow just for the debt. And also a big issue is, a lot of his debt comes due soon. The current debt is $5 billion. They will have to refinance that debt. They can't pay it off. They'll have to pay a way higher interest rate on that. Meanwhile, while CVS has higher debt loads of $65 billion, they have a lot of liquidity. They have $16 billion on hand right now. Plus, they are growing cash flow. They have $17 billion of free cash flow. Their free cash flow to debt multiple is way, way lower. And they also bought back shares, but they also issued new shares. They issued basically 30% of shares to buy Aetna. And it was an expensive acquisition, but it put the company on a long-term growth perspective, which I think it is worth it to issue those shares. The shareholders got value. Free cash flow has been massively increasing. It was a way better allocation than buying back shares in that case. Now if Walgreens would want to compete with CVS in these fields, which are, in my opinion, the future of those pharmacy businesses, they would have to A, buy other companies, or B, create them themselves, both of which require a massive amount of capital, which CVS was able to get by issuing shares and issuing debt, but Walgreens doesn't have that option. Their share price is at rock bottom. If they would issue shares right now, they would dilute their shareholders so much. And they also cannot really issue much more debt. That is already a very high debt load, which they are trying to reduce right now. And to be fair, they have been doing that since 2019. While CVS continues to grow, they just did 2 recent acquisitions this year. Walgreens is just not able to do anything. The latest increase in net debt for CVS, by the way, has been due to 2 acquisitions, which was Signify Health and Oak Street Health, which are in the primary care and healthcare services sector. And they said for now they will stop the acquisition spree to more integrate these businesses. But that also means more cash flow is gonna go back into either paying down the debt or buybacks or paying more dividends, which is good. So now, if you see Walgreens only as a pure dividend play, and remember, they're taking on debt right now to pay this dividend. They're paying 1.6 billion in dividends each year, but they have no cash flow right now. And they have not really raised the amount of dividends they pay out since 2016. The small increase in dividend has just been due to share buybacks. So they basically just increase the amount of dividend they pay by the amount of shares they repurchased. If you just count on this 8.8% dividend, I would say that dividend is fairly safe. I don't think they're gonna cut that, or if they cut it, not by a lot, maybe to preserve cash, if free cash flow stays in the negative for much longer, but I don't think the free cash flow will be below the amount of dividends they pay out for much longer. But even then, you would count on a multiple expansion to make a lot of money with a stock. While 8.8% is a nice yield, at that point I think you would just be better investing in the S&P and getting the same return for way less risk. On the other hand, you could invest in CVS, which is growing in future markets and has a way better balance sheet at the same time. Now when it comes to valuing CVS, for me, I count with a 9% growth rate in free cash flow per share for the next 5 years and a 6% after that. I chose a free cash flow per share of $10. It is 13 right now because free cash flow has been going up a lot lately. If there's a correction, I don't want to be caught on the wrong side, so I have a big margin of safety. Dividend payout ratio of 22%. There is a 10% discount due to immediate taxes. Discount rate of 10%. That would be a nice return for me on the stock. I would get a fair value for the stock of $122. It is currently sitting at 71, so that's a 73% discount in my opinion. I think CVS is a great investment. I also think Walgreens is an okay investment. I don't think you're gonna lose money with Walgreens, but it is just not my kind of play. It is a company in decline. I don't know where this decline will end. I don't think they can turn it around really. They do not have the balance sheet for that. They do not have the equity issuance potential for that. So I would say CVS, risk adjusted, a way better return. CVS is 13% of my portfolio. What do you think about it? Do you think CVS is actually that much better than Walgreens currently? Write it down below. I thank you for watching. Have a good day.